Ladies and gentlemen, good day and welcome to the Yes Bank's Q1 FY2024 earnings conference call. On the management panel, we have with us today Mr. Prashant Kumar, MD and CEO, Mr. Rajan Paintal, Executive Director, Mr. Niranjan Banodkar, Chief Financial Officer, Mr. Ravi Tota, Country Head, Large Corporates, and Mr. Sunil Parnami, Head of Investor Relations. Mr. Prashant Kumar will give an overview of the results, which will be followed by a Q&A session. As a reminder, all participant lines will be in the listen-only mode. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashant Kumar, MD and CEO from Yes Bank. Thank you, and over to you, sir.
Very good morning, and thank you for joining so early for Yes Bank Q1 earnings call. Starting first with the headline view. At an overall level, Q1 was a steady quarter, where we have continued to demonstrate good progress on our strategic objectives. While there was a continued momentum in balance sheet granularity, we also delivered strong growth in our fee income while containing our operating and credit costs. Having said that, as we undertake the journey of transforming the bank, few areas remain as work in progress, and we look forward to continue our work on those in the coming quarters. A key highlight during the quarter was the launch of our refreshed brand identity. With a strong foundation firmly in place, we felt that it was an opportune time to have this strategic move of reimagining the Yes Bank brand. As part of the refreshed brand identity, a vibrant new logo has been launched, which carries forward the visual DNA of the bank, and we build on it. This has been accompanied with an integrated 360-degree brand campaign with a positioning Life to Banao Rich, which resonates with our deep commitment to empower our customers to focus on their most valuable account called life, while allowing us to take care of their banking needs. The initial feedback of the campaign has been extremely positive, and we believe that this will not only instill enthusiasm and confidence among our stakeholders, but will also enhance the pace of customer acquisition. Now moving over to numbers. As we had already uploaded our investor presentation on Saturday, I will cover select financial highlights for the quarter. Advances growth, adjusting for the ARC transaction, was 10% YOY. The granular segments continue to grow at a faster pace, with retail advances growing at 31.3%, SME by 24.1%, and mid-corporate segment growing 28.9%. While corporate advances further contracted during the quarter, the non-fund based outstanding balances have grown by 12% YOY and 4% quarter-on-quarter. We expect this good momentum to continue over the coming quarters. Deposit growth, excluding CDs, was 16.2% YOY. The credit to deposit ratio also improved marginally to 91.3% from 92 in the last quarter. Even within deposits, the retail segment sustained the growth momentum with 23% YOY growth. Net interest margin at 2.5% was up 10 basis points YOY. However, on sequential basis and as guided earlier, there was a compression largely due to deposit repricing. A strong momentum in non-interest income which grew 54% YOY and 13.7% quarter-on-quarter, backed by strong traction in third-party sales and trade and remittance fees. The cost-to-income ratio was at 73.9 compared to 71.4 in quarter 4. Despite retailization, the cost to assets at 2.6% has remained largely flattish over the last 6 quarters. Net profit at 343 crores has grown by 10.3% YOY and 69.2% quarter-on-quarter. Bank reported an ROA of 0.4% as compared to 0.2% in quarter 4. Coming to asset quality, in quarter 1, the gross slippage was 1,430 crores against 1,072 in quarter 1 last year and 1,196 in quarter 4 last year. However, slippages, net of recoveries and upgrades, were at 764 crores, which is similar to last quarter of 740 crores. Within large corporate, fresh slippages were majorly due to one large account. Overdue book between 31 to 90 days reduced by almost 1,000 crores on quarter-on-quarter basis. Resolution momentum continues to be strong with total recoveries and upgrades of 1,201 crores. Overall gross NPA ratio reduced to 2% from 2.2. Net NPA and net carrying value of security receipts remained flat at 2.4%. And lastly, the CET ratio, including the warrant application proceeds, is at 13.6 against 13.3 in the quarter 4. Now, before taking your questions, I would also like to spend some time on bank's medium-term transformation and ROA improvement roadmap. We believe the focus of the bank is now firmly aligned towards improving the profitability and accelerating the momentum over the coming few quarters. Towards this, we continue to work on, number 1, to drive improvement in our NIMs and CASA ratio, to reduce the drag of legacy PSL requirements, to intensify cross-sell and product penetration into our fast expanding customer base, and continue to maintain strict control over operating and credit costs. Some of this has already started to reflect in, for example, in quarter 1, the share of high-yielding product mix in retail advances improved from 31.5 to 32.5. The current account balances have grown by 27% YOY, but declined 9.3% quarter-on-quarter. However, the average daily balance of current account for quarter 1 has grown by 20% YOY and 2% on quarter-on-quarter basis. While there has been a degrowth in savings bank accounts on YOY basis, which is actually because of the decline in the higher value bucket. However, balances in the lower value bucket for 5 crore and below at account level have seen healthy YOY growth. The bank registered a strong 33% YOY growth in our rural advances. Our rural disbursement witnessed a strong growth of 34% over quarter 1 and 62% over quarter 4 of the last financial year. YTD, the bank has bought PSL certificates amounting to 4,300 crores. For reducing RIDF drag, the bank continues to actively engage with select BC partners for organic growth opportunities, while we simultaneously evaluate the target for potential acquisition as well. We continue to invest in our branch network and people. We have added 20 new branches and 1,000 new employees during the quarter 1. While we continue to invest in our physical distribution, in Q1, more than 90% of our saving accounts and 55% of our individual current accounts were opened digitally, showcasing our commitment to further improve our productivity and response time. All the above points demonstrate a strong momentum in the build-up of a good quality granular franchise. With this, I want to thank you once again for taking the time out for joining this call and wish all of you and your families good health and prosperity. We can now open the floor for your questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Avinash Kumar, an individual investor. Please go ahead.
Good morning. Good morning, sir. Avinash. My first question is, few months ago, as I have read somewhere that a bank is looking for few microfinance, acquiring microfinance. Right? So what is the timeline for that, and how that is from internal accrual, or Yes Bank will raise fresh fund for this acquisition?
So Avinash, first thank you so much for joining us. And related to this question, and I think we have given a guidance that we are looking for a inorganic growth in the microfinance space. And fundamentally, this was for two purposes. One, we have a drag on our PSL, almost 35 basis points. Second, we don't have any high-yielding asset book as of now. So I think we continue to evaluate some of the assets which are available in the market, and we would be expecting, like within this financial year, we should be in a position to close this acquisition.
Okay, sir. Okay, fine, sir. And second question, sir, is our ROA is 0.4, right, this quarter. And NIMs is slightly above from quarter on quarter. I think quarter on quarter is declining, and year on year is improvement by 8%, I hope. So NIMs, if we look at other bank quarter on year on year results, their NIMs are quite high. NII, sorry, NIMs, not NIMs, NII. So when S Bank NII year on year is improved, it is not understood. NIMs is not, NII is not improving that much comparing to other banks, large banks.
So Avinash, you would appreciate for us this is a journey, and maybe this is not the right time for comparing with some of the large banks. But I think this is a journey where we have already started moving on. And like what your first question in terms of MFI, I think there is a drag because of the shortfall in the PSL. That is one part. And strategically, our corporate book has come down. But going forward, I think we would be able to have a better loan growth, which would improve the net interest income for the bank. And you must have seen like we are doing very well on the non-interest income. So I think with this, some of those things and with the improvement in CASA ratio, solving the problem for the shortfall in the PSL and growing on the loan book, especially on the corporate side, we believe that in the coming times, both NIMs would also improve and ROA would also improve.
Okay, sir. Okay. Thank you, sir. That's only my side.
Thank you.
Thank you. We have the next question from the line of Sri Karthik Vilamakani from Investec. Please go ahead.
Hi, thanks. Could you walk through the sequential capital movements in terms of how the CET1 has played out for you in this quarter?
Sure, Karthik. So I think one material update we wanted to also provide, and that's actually part of the presentation, is we've accreted about 35 to 40 basis points on account of the warrant upfront money that we've received, which is about 948 crores. As a consequence, the CET1 has gone up. There has been a very marginal consumption of CET during the course of the quarter. So organic movement, marginal consumption, a few basis points, but largely accretion coming in on account of the warrant money, which is 25% of the total warrant consideration.
And including the residual inflows, what would be the CET1, Niranjan?
So if we were to add the residual 75% of the warrant money, we should be accreting another 110 basis points to CET1.
Got it. And the second question is with respect to the general the PSP market share that you carry on the UPI front. Any thoughts on how you looking to monetize that as things are evolving? We're seeing some of them making progress on digital lending and with regulatory clarity also emerging. Is there any thought process as to how you can monetize that particular market share?
So Karthik is on the monetization of this particular area. It is more in terms of where after using the analytics, we would be able to acquire the customers through this channel. So I think last, say, 12 to 15 months, lot of work has happened in this area. And I think we are in a much better position as of now for getting the business leads out of this area. But I think this is a journey. It would take another, say, 3-4 quarters where we would be able to have a significant advantage of this data for the customer acquisition.
Karthik, if I can also add, when we look at, let's say, the UPI or for that matter, the entire API banking solutioning, even on a standalone basis, it is profitable because what happens is we don't just look at the fee that we charge or we get as a consequence of these transactions. As a consequence of the solutioning that we provide, we also end up getting current account float that remains quite sticky in our balances. So if I were to just look at our current account balances, more than 50% of our corporate CA actually comes in from accounts where we are providing these API banking solutioning, right? So the point is, what we will look at monetizing is will further propel or the profitability for this particular solutioning that we are providing. But on a standalone, I mean, there is already the NII that we are benefiting from through the free float.
I see. Got it. And the breakup of corporate between mid and large suggests that the large segment is down 30% YOY and 8% QOQ. That would continue just to ensure your PSL compliance, or is there a floor to which you would take that from a mix perspective?
So Karthik, this 30% down and 8% down on quarter, to be very frank, is not in terms of strategy to take it down further. But definitely there were some high-risk assets where there have been the prepayments, and there have been some prepayments in other assets which were not expected. But definitely as a strategy, we would not like to take it down further. But depending on our ability to match the pricing in the market, we would be definitely growing on fund base. But if the pricing would be a challenge, we would take exposure on the non-fund side. And you have seen, like on the non-fund side already there is a traction. So I think overall on the exposure on the corporate side, we would not like to bring it down further.
Thank you, Prashant. Thank you, Niranjan.
Thanks, Karthik.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Yuvraj Chaudhary from Anand Rathi. Please go ahead.
Good morning, sir. Thanks for the opportunity. Sir, firstly, how much of our deposits has already been repriced?
So, Yuvraj, in terms of, I would say, pendency for, cost of deposits, I would say we should have about another 20 basis points of cost of term deposits to come through. Just from a margin perspective, we will have about, anywhere between 5 to 10 basis points. But that doesn't mean the margins will necessarily only get weighed down by this, because as we are progressing, while all of it we were not able to express in Q1, on the retail assets, we are also beginning to see the incremental disbursements happening in products that on the margin is better from a margin perspective, NIMS perspective. So, just to respond, we will have about 20 basis points of cost of term deposits pendency from a repricing standpoint.
Oh, sure. Secondly, so how much would be our total exposure towards ECLGS?
One second, we just provide that. So, Yuvraj, we'll come back specifically on this number.
Sure. Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on their touchtone phone. We have the next question from the line of Badrish Meghani from BEAM Consultancy. Please go ahead.
Good morning to all the management people. I would like to know about 2 things. What are the plan of increasing number of branches and number of employees for this financial year? And the second question is, what will be the budget for the advertisement for this financial year? Is there any big way the advertisements are going to come in the market or not?
So, Badrish, for branch expansion, we have a plan to open 150 branches during the current financial year. 20 branches have already been opened in the quarter 1, and we would be opening the remaining 130 branches in the next 3 quarters. We have already added 1,000 employees in the quarter 1, and we would be increasing another, say, 500 by the end of March 24. Okay. Regarding the advertisement, say, budget, what we have done for our brand refresh, we have integrated our normal advertisement and the marketing with the brand refresh campaign. So overall, there would be a 25% increase in our existing marketing budget. But definitely brand refresh is something which is critical, and you must have seen like we have already started doing advertisement around our brand. So, but overall, there would be an increase of 25% in our marketing budget.
Okay, thank you very much, sir.
Thank you. Participants who wishes to ask a question may press star and 1 now. The next question is from the line of Amit Kumar, an individual investor. Please go ahead. Mr. Kumar, I'm sorry, your audio is not clear, sir. Mr. Kumar? As the current participant is not answering, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. We have the next question from the line of Debesh Agarwala from ITPI Capital. Please go ahead.
Yeah, good morning, sir. Thank you for the opportunity. Sir, 3 questions from my end. What percentage of our restructured book are yet to come out of the moratorium?
All the 3 questions, we will respond then.
No, okay. I'm coming with all the 3 questions. So, first is, what percentage of the restructured book are yet to come out of the moratorium? Second, what is the total slippage from the restructured book till now? And third is, what is the breakup of advances in terms of fixed rate and floating rate?
Repeat the third one, please.
What is the breakup of advance book in terms of fixed rate and floating rate in terms of MCLR, repo link?
Okay, I can take the last question first. We have about 60% of our advances which are floating in nature. Actually, the number is 57%. From the balance of 43% which is fixed, we have about 10% which is actually short-term in nature. So if you look at floating plus short-term, we would be 2/3 and 1/3 is fixed rate book. That's on the entire fixed floating. I think the second question that you had was in terms of what have been the total slippages from the restructured book. So in fact, that number has been quite non-material or insignificant. In fact, we've seen a good performance of either upgrades or a continuing strong performance in our restructured book. So for example, even if I look at my current position of restructuring, and let's say DCCO related, we have about 1,500 crores. In fact, in almost all of the cases, we either have accounts where there is change in management or there are projects which are almost near completion. So that portfolio is doing well. If you look at COVID restructured book, out of the 2,400 crores that we have, I can very clearly say about 2,000 crores is where we continue to see very strong improvement. There is, in fact, also been principal repayments that we've seen in those accounts as well. Very recently, there have been also rating upgrades, not internal but also external rating upgrades that we've seen in that book. So we're quite I would say, quite satisfied with the performance that we've seen out of our restructured book, and the balance, about 4,700 crores in our view, will hold quite good in terms of performance in the near term.
And David, your first question, almost the entire book is out of the moratorium.
Okay. Sir, in terms of floating rated loan, can I get the breakup between MCLR and repo link? What percentage of the book is linked to MCLR and repo?
So MCLR would be about 18%. We will have repo at about 26%. The balance will be a mix of CDs and T-bills as well.
So the entire MCLR loan book will be repriced or something is yet to be repriced?
There is a tendency for repricing that will play out, which is typically sitting in the 6 months to 1 year time bucket.
So it will be repriced over next 2 or 3 quarters?
You can say 2 quarters.
Okay, sir. Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. Ladies and gentlemen, we have some issue with the line of the management. Kindly hold while we try to reconnect the management. Thank you. Ladies and gentlemen, thank you for patiently holding. The management's line has been connected. We take the next question from the line of Maruk Rajania from Nuvama. Please go ahead.
Yeah, hi, good morning, sir, and everyone. So my first question was, where do you see margins bottom out? Have margins bottomed out now? Because we have only 20 basis points more of term deposit cost correction, or there'll be still some more correction in the quarters to come?
Good morning, Maruk. We don't see any further decline in the margins. I think they have been bottomed out.
Okay. And so so how do we build in recoveries from the ARC, right? So obviously, slippage, in terms of recoveries, will that be smooth or will there be lumpy recoveries? How do we budget for that?
No, I think what we are looking at, recoveries from the ARCs, there is always an issue of the timing, which is outside the control of anybody because there are so many resolutions which happen through the legal process. But we are not looking for a, lumpy recovery. And in the past also, after this transaction, after December, I think we are seeing a very consistent or persistent recoveries in the large accounts as well as the small accounts. So I think so far there has been a very good traction, and we have a visibility that this momentum would continue. For next 2 years, I think we are going to see very good recovery.
Got it. So basically, the net credit cost guidance would be how much?
No, so I think we continue to remain our earlier guidance of 40 to 50 basis point of credit cost.
Okay.
Yeah.
Okay, sir. Thank you so much. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Bhanu Arora from Bhanu Road Lines. Please go ahead.
Hi, sir. Good morning. I just wanted to ask, is Yes Bank planning to distribute any dividends in near future to its shareholders?
No, I think, Dhanu, if you see we have already moved on that path of delivering on the profitability. But I think once we reach at a stage, where we would be having a good return to our investor, definitely at that point of time it would be considered for the dividend share.
Thank you, sir.
Thank you. The next question from the line of Chintan Shah from ICICI Securities. Please go ahead.
Hello. Yes, thank you for the opportunity. Just one question on strategically from my end. So, sir, considering our ROA of 0.4%, and also what would be our aspiration for FY24 or FY25? And also, would it be, so given that we have already mentioned that margins have bottomed out, so it would be largely driven from margins, or is there also some scope for reduction in OPEX, since we believe the credit cost is largely where we are expecting, and other interest income also has limited scope from here on. So your thoughts on this same? Yeah. Thanks.
So Chintan, like if we see for us the ROA of 1% in medium term would be a function of 3-4 different things. One is definitely improving the CASA ratio. The second is also improving our loan growth, and also along with the improvement in the yield on the assets. The third part is definitely to solve the problem of the drag on our ROA because of the shortfall in the PSL, which is a very large one, almost 35 basis points. I think this is something which we are working on. And the fourth is definitely our growth in the non-interest income and the recoveries and the resolution from our bad assets.
Sure, sir, got it. And sir, one more thing on our CET1 case which has been pending. So is there any update on the same, on that Tier 1 case which is pending in the Supreme Court? Or any timelines for the same?
No, I think that this is pending in the Supreme Court, and the next date is 4th of August.
Sure. Okay, sir. That's it from my end. Yeah, thanks.
Thank you. We have the next question from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, good morning, sir. A couple of questions only. One is that there seems to be some restatement of OPEX and other income in this quarter. What is that pertaining to?
So, Jay, basically, what we did is we just reviewed the accounting for some of our interchange and digital banking products. And that has been basically, we've removed it from the OPEX line, but we are talking about numbers which are about 50 crores and 60 crores. I think the range is about 50 to 70 crores. That's the broad range we are talking about. And that we have actually netted from the income because these were basically OPEX, which was very incidental and part of the same transaction where the revenue was coming from. So just from an accounting standpoint, we've actually netted that from the non-interest.
Right.
But this is not a material number. As I said, on the quarterly basis, we are looking at a range of anywhere between 40 to 70 crores that we've adjusted in these quarters.
Okay, and Niranjan, on security receipts redemption, right? So do we also get AMC fee on managing such a large security receipts portfolio, or we do not earn any management fee from this SR?
So Jay, pursuant to the sale which we did in December, the entire management is now in the hands of the asset reconstruction company.
Right.
So, in fact, as part of the structure, and this is quite common in the entire security receipts market, that actually we end up paying a certain management fee to the asset reconstruction company. So the bank is now no longer part of the resolution of these assets. Of course, we are quite interested in knowing what's happening, but at the end of the day, it is for the asset reconstruction company to drive the resolutions, and whatever resolutions happen, we benefit through the redemption of security receipts.
So this quarter 442 have been redeemed. So the impact on our financial has been that security receipts have converted to cash. Right? That has been the broad implication.
That's right, Jay. So any redemption results into receipt of cash.
Right. Okay. And the last quarter, and I think in the opening remark, I heard that, we are something with effect to PSL, that either they are coming down or, we are doing something there. So I recall we had a 8% of balance sheet in RIDF as of last quarter. Has that changed materially, or I had actually missed that comment on PSL?
No, Jay, so the RIDF deposits to assets continues to be in the 8 to 9% range. In fact, in June we did have some increase in those balances because there was a call that we received, demand that came through in June quarter. So what Prashant was mentioning is clearly, for us to be able to reduce that drag, there are three ways in which you can tackle it. One is from an immediate perspective, accelerate on two fronts. One is organic creation of assets that satisfy the small and marginal farmer and the NCF and weaker section category. But there is a limitation that you will have from an organic accretion, right? The second is that you could buy PSLCs. So what Prashant was mentioning is we have already in June quarter purchased about 4,300 crores worth of PSLCs to fulfill the PSL requirements in these specific categories. And the third is that we are also evaluating inorganic opportunities for us to be able to comply with these requirements. So it's a combination of the three, which will ensure, and that's really our priority focus, is to ensure that from fiscal 24 onwards, we should not have incremental requirements of RIDF come through in subsequent years. Of course, there is a legacy deposit book, which is what we discussed, 8 to 9%, which is sitting, but that will hopefully age and mature over time. But at least from an incremental perspective, our endeavor is that we don't add to this book
or burden from here on.
So, Jay, basically whatever we do this year would result into the lower demand for the next year. So whatever we do on the PSL side would actually give us the benefit from the next financial year onwards.
Right. Understood, sir. And lastly, Niranjan, if you have the RWA number for our bank in absolute rupees crore, that would be the last question.
That number is 2.46 lakh crores.
Sure. Okay. Thank you and all the best.
Thanks, Jay. Thank you very much.
Thank you. We have the next question from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Yeah, thanks. Thanks, sir. So, firstly, the question on credit yield number. So, there is some volatility in the number in this quarter on the downward side. So could you help us understand what is the reason for the same?
So, just from our advances yield, actually, what also happens is there are certain recoveries that we also get in our NPA stock to the interest line item. That is also what causes some amount of volatility. But at a core performance level, the yield on advances actually has been broadly flattish sequentially.
So I think it has kind of fallen by around 10 bits. So is that in the corporate book repricing, or there is some struggle that we are facing on the loan pricing side, especially on the corporate book? Is that the reason, or there is some other reason?
So no, let me respond in different ways. I think if you are comparing on a sequential basis, like I said, there is also a noise that comes from interest recoveries from the NPAs, which also results into certain noise. So, for example, June quarter we actually had hardly any NPA interest recovery, right? Whereas let's say in March quarter we did have, right, which has resulted into some compression in the yield on advances. However, I think the point that you mentioned was on pricing pressures. I think that gets reflected in the loan spread. So, for example, if we were lending at a certain rate, even despite, let's say, increase in the cost of deposits, are we able to, let's say, price some of those out? I think there, yes, we do see pricing pressures in actually various businesses and products, but to be honest, from our vantage point, what we are very conscious about is we are calibrating our growth in products, especially on the retail side, which gives us better margin because we've now built the experience and volumes in those respective product lines. So just to give you an example, if I were to look at the entire vehicle as a segment, our incremental disbursements in let's say used cars is actually higher than new auto cars, right? And it's not that by virtue of that we are venturing into higher risk category. It's just that it's a product where we are able to get a better risk return profile. Similarly, when we look at let's say areas like home loans and affordable home loans, our incremental disbursements in affordable are actually trending higher, right? So we are conscious of the segments that we need to operate. We are conscious of the business that we need to operate so as to help us, maintain our loan spreads. There is one element that has, in addition to, because there was a question earlier also on net interest margins, in addition to deposit repricing, there has been certain, because there's also seasoning that's playing out in our retail book as well. So some of the old retail loans are also, as they're redeeming, the redemption is because some of these were originated in 2018-19. So we've seen some reduction in loan spreads as a consequence of that as well. But I think broadly in Q2 we do believe we should have the bottoming out of net interest margins, and that too marginally. We are not going to see
the magnitude of margin compression that we saw between June and March. Sorry, a little bit long-winded answer, but I just thought I'll give you the full perspective.
Yeah, that's quite helpful. And the LDR number is like, there is a scope to, improve that number. So what is the kind of credit growth that we are anticipating for this fiscal year?
Sorry, what number are you referring?
You are talking about the LDR, loan deposit ratio?
Yeah, so there is a scope to further improve it, further increase it. So what is the credit growth that we are looking at for this fiscal year?
No, I think if you see a balance between the loan deposit ratio from the perspective of liquidity and the profitability, we believe that around 90% is the right way. Okay, so we are looking for a credit growth between 15 to 20% and deposit growth of more than 20%.
I was looking at credit to deposit and borrowings numbers, so that I have 68%. Yeah, okay. So, got it.
Not 68, sorry.
Sorry, Rakesh, can you please I think if you can go to the numbers again, because we don't want a gap in understanding. What did you mean by 68%?
Credit as a denominator at deposit and borrowing. So that is the way I was looking at, which is 68% number as per our calculation.
Okay.
Credit as a proportion of deposit and borrowing. So that number was 68%.
So Rakesh, I think the more relevant metric from our vantage point is actually the CD ratio, which is just loans and deposits. As you see, we were at about slightly over 92% for March. That's marginally improved to about 91.6% for June. Our endeavor is, as we go through this financial year, to get the LDR below 90%. That's really our endeavor.
Got it. Thank you. Thank you, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Prabal from Ambit Capital. Please go ahead.
Yes, thank you. Good morning. So my first question is on the retail slippages that continues to be at 3% plus for...
I'm sorry to interrupt, Mr. Prabal. Your audio is not clear, sir. May we request to use your handset, please?
Is it better now?
Please continue.
Yes. So my first question is on the retail slippages. So that continues to be 3% plus for us. So first, are these the normalized levels that we should expect going ahead? Or is there a scope for improvement here?
So I think we will be able to continue at a current level with some improvement coming in. So one is that we are also going in for some high assets, and anyway April has its impact with lesser number of days available. So more or less we'll be able to maintain at the same level.
Okay. And in addition to that, can you highlight your retail strategy, maybe in terms of distribution across various products? How much is done in-house? How much is via DSA or other channels? And what are the approval rates that we have typically across DSA?
Yeah, so approval rates will actually vary from product to product, but just to reflect on the distribution, our approximately 23% of the business is coming from the branch network, and all put together, approximately 37 to 38% is coming from internal channels, including the phone banking and all relevant channels included. In our overall distribution strategy, we are largely focused on on the internal business, which is moving very well, and with the increase in the database and also with our branch network now more equipped to handle multiple products is moving well, and we can actually move upwards of around 25%. On the other channels other than internal are basically the dealers and the corporate DSS, which is approximately around 60% which is going in. We work on the partnership with the fintechs, but that is not to the extent of approving it online. It's more in terms of a synergetic relationship, which is less than 5% as of today.
Okay, approval rate is less than 5%.
Sorry?
You are saying approval rate is less than 5%?
So, no. Approval rate would actually vary from product to product, but let us say the product where you would be most interested to know around personal loans would be around 60 to 62%.
60 to 65%.
Yeah.
So, I just wanted to also call out for the retail slippages because you had a question on, and Rajan did mention that we broadly see the trends. I think what I also wanted to call out is if you look at slippages net of recoveries and upgrades, that number continues to be trending in the ballpark range of about 40 basis points on a non-annualized basis. So I think that trend will continue. So while there might have been some increase in the let's say slippage for June quarter for the reasons that Rajan alluded, but we also did see good quantum of upgrades and resolutions that played out. And I'm not talking about write-offs here, just upgrades and recoveries, the core resolutions. Thank you.
And the last question would be, what is the desired level of provision coverage ratio that you would want to have?
Desired ratio?
Of provision coverage ratio. Currently it is at 48% or
No, I think this somewhere around 60% would be the desired number.
And after building this, we expect that we can continue to have credit cost of 40 to 50 basis points.
No, I think the credit cost, when we are talking about 40 to 50 basis point, I think that is taking into account the aging provision as well as the recoveries and the resolution. So I think we would be in this range.
Okay. All right. Thank you and all the best.
Just to also clarify, when we talk about credit cost, this is non-tax provisions effectively to total assets.
Oh, okay.
Thank you.
Okay, thank you. All the best.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to Mr. Prashant Kumar for closing comments. Over to you, sir.
Thank you, and thank you everyone for joining the call so early in the morning. But I think we would like to reassure all our stakeholders that transformation of the bank on the desirable direction has already started, and we are seeing the results in the quarter one. And I think in the coming time, we would be seeing a much better execution on our desired strategy. Thank you so much.
Thank you, sir. Thank you, members of the management. Ladies and gentlemen, on behalf of Yes Bank, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.